How to make money in real estate. Lecture 5. What is return on investment? ROI. When you buy an investment property, you hope to make money on it and get a return on that investment property, whether in the short term or longer term. The purpose of real estate investing is to make more money than you put down. This is where return on investment comes in. Measuring ROI allows investors to decide whether putting money into a particular investment is a wise choice or not. Return on investment is the measure of how much money or profit you make on an investment property over the life of holding the property, as a percentage of the cost of that investment. It shows how effectively and efficiently investment are being used to generate profits. Return on investment compares the gain or loss from an investment relative to its cost. Return on investment is a ratio, but it is typically expressed as a percentage rather than as a ratio, because percentage is easy to understand. Return on investment in real estate comes from two sources: regular income from rents, appreciation from holding a property over time. The goal should be to hold property for at least 10 years. This gives you a better chance of realizing returns from both income and appreciation. To calculate return on investment and evaluate real estate investment, we use other several factors. Return on investment is equal to the final value of the investment minus total cost of the property plus total net cash flow before tax divided by the cost of the property multiplying by 100. Real estate investing has 4 ways to make money: property appreciation, property cash flow, loan debt pay down, tax benefits, building depreciation. Property appreciation. Appreciation is how much the property value increases over time. Keep in mind that we consider the average appreciation per year. Some years saw worse, even negative, and some years saw well. What appreciation rate should I use for modeling investment properties? There is not a clear answer to that question. The majority of investors consider somewhere between 3% to 5% for annual appreciation. While you're making a return from appreciation, you are not getting cash deposited into your bank account. You are building equity in your property. Once your property gains enough equity, you have the options to sell the property. Property cash flow. Out of the 4 ways of making money, people are most familiar with cash flow. Cash flow equals to rent minus expenses, before debt pay down and taxes. Down payment required to buy the rental property is not the total investment. There are other expenses associated with buying the property, which I have introduced in detail in Lesson 3. There is a cost to buying, maintain, improving and selling real estate. The most common expenses to consider when financing a rental property are loan cost, down payment, appraisal fees, home inspection, insurance, closing costs, property taxes, maintenance, property management, vacancy costs. If you have a property that rents for €1,800, rent minus €500, expenses, is equal to €1,300, which is the monthly property cash flow, before debt pay down and before taxes. Debt pay down. You only get the debt pay down if you finance your rental property. If you pay cash, you won't get this return. Very few rental property investors buy properties only with cash. The table below shows the first few payments on a typical €400,000 mortgage at 4% over 30 years. The first column, payment, has the same amount every month. The next 2 columns, principal and interest, change monthly because as you pay down the loan, your balance decreases. Each month you'll pay a little more towards the principal. Through paying down your loan. Not you, it's your tenant. With no cash from your pocket, your tenants are buying you more of your property by building your equity. Obviously, you have to make your monthly payments to get this return. If you don't make your payments, you don't get the monthly principal reduction and will have problems on your hands. The debt paydown return goes away after the loan is paid off. Property tax benefits, depreciation. Depreciation benefits are based on the tax law of each country or state. For more details, make sure you consult a tax professional. Only investment properties receive these tax benefits. Depreciation can generate significant tax savings, which indirectly puts money back into your pocket. When you purchase a rental property, you're buying the land and the building. The land does not depreciate, only the building does. Land assessed value is equal to €5,000, which is equal to 15%. Building assessed value is equal to €30,000, which is equal to 85%. Total assessed value is equal to €35,000, which is equal to 100%. The government allows you to depreciate the property over 30 years approximately. €35,000 divided by 30 years equals €1,167 for my annual tax benefit. How much this tax deduction benefits you ultimately depends on your personal tax situation and tax brackets. Every person will ultimately receive a different benefit on their taxes. The above depreciation is only for tax purposes and it is not the real depreciation of the building. Speculative risk and uncertain returns. Appreciation and cash flow depend on the conditions of the market. Therefore they are uncertain. You can take your best guess at modeling them, but not with 100% certainty. Cash flow is easier to predict than appreciation, but it is not guaranteed. The important point is to understand that neither is guaranteed. To get your complete real estate investing ROI, you simply need to add up each return. Knowing the return on investment for any investment allows you to be a more informed investor. Before you buy, estimate your costs and expenses, as well as your rental income. This gives you a chance to compare it to other, similar properties. Once you've narrowed it down, you can then determine how much you'll make. If, at any point, you realize that your costs and expenses will exceed your return on investment, you may need to decide whether you want to ride it out and hope you will make a profit again or sell so you don't lose out. Example. Property purchase price is €100,000. Down payment is €20,000 or 20%. Mortgage balance is €80,000 or 80%. Loan cost is €1,200 or 1.5%. Property inspection cost is €500. Closing cost is €3,000 or 3%. Repair cost is €5,000. The total initial investment cost is equal to €29,700. The property has annual income from rents is equal to €10,000. The vacancy cost is €600, or 5%. Property management cost €1,200, or 10%. Maintenance cost is equal to €600, or 5%. Variable expenses are €250, or 2%. Property taxes are €500. Insurance cost €150. Total annual expenses are equal to €3,300. Annual property cash flow is equal to €6,700. Loan interest rate is equal to 4%. Loan term is for 30 years. Mortgage payment, debt paydown, is calculated to €381.93. multiplied €381.93 by 12 months. The debt paid down is equal to €4,583. Annual cash flow before taxes is €2,117. Annual appreciation is considered to be equal to 5%, let's say €5,000. Let's consider that you hold the property for 30 years. In this case, 30 years cash flow before taxes is equal to €63,510. The present value of is estimated to €24,000. The appreciation over 30 years is €150,000. So the final value of the property is equal to €250,000. The present value of is estimated to €95,000. Present value is the concept that states an amount of money in the future is worth more than that same amount today. In other words, money received in the future is not worth as much as an equal amount received today. Now let us put the above numbers in the equation to calculate return on investment. Return on investment is equal to the final value of the investment, minus total cost of the property, plus total net cash flow before tax, divided by the cost of the property, multiplying by 100. Return on investment over 30 years is 300%. The average annual return on investment is equal to 10% and includes both appreciation and annual cash flow. Thank you for watching the video. If you watch all my lectures, which are free, you may be able to start investing in rental properties a little quicker. In the next lecture I am introducing the method to calculate the value of an investment property. Please subscribe to my channel and press the bell to get alerts when a new video is posted. Please write your comments, questions, or concerns you would like to share.